All right, let's see. Can you guys hear me on the stream? I believe we're live on YouTube and X. I'm just going to send out a quick tweet and give people a minute to get situated before we start. All right, stream's working fine. Great, thank you. Appreciate that. You can hear me on YouTube. Awesome. Cool. And I got Twitter working as well. Matt will show up in a few minutes. And so today, what we're going to do, we're going to talk about how dealers move markets. So specifically how option flows and option hedging moves markets. We're going to cover the how and the why, and then cover all the basics, gamma, charm, positions, etc., and importantly, how to trade it, and then how to trade it with our platform, of course. So as I get started, you can see here, this is VS3D. We'll be talking through the lens of VS3D. If you guys aren't familiar with the angle here, my name is Daniel Roos. I used to work as a partner with Belvedere Trading. I was market maker for 15 years, my entire career. At the end of my career, near the end of it, really the last 5 years, it became obvious that our hedging flows, so much of the market was option driven. You know, Jem Carson likes to say this line all the time. Options are the underlier these days. Of course, it's not quite that extreme. If it's that extreme, it'll be a real problem for the market. We're not quite there. But options really do represent a huge amount of the volume, but not in the way that everybody first thinks. So if you ever come across cheddar flow or unusual whales and their callouts, you probably sometimes get frustrated by how clickbaity they are and how little information you actually get. So we're going to cut through a lot of that noise, obviously, and I'll encourage you guys to think about flows in this particular way, because one thing I want to remind you, whenever you come across something that already happened, that impact is not tradable, right? I don't believe you're going to get good, really good outcomes, unless you have something predictive. And I can tell you straight up that I've never really seen a good trade print being predictive. What I can tell you is that our flows, our hedging flows, are dependent upon our positions. So an option, for example, is a prescription. When you sell us a call, us being the market maker, we're going to actually manage that position for you in order to do what you need as the option seller. It works for a buyer too. I guess maybe a buyer makes more sense. As an option buyer, if we sell it to you, we're going to replicate the market's process around that call so that at the end, we can deliver you your payout. You know, the business of market making is not just about scalping your bid and ask, of course. We do a lot more than that. We have to be held accountable to hedge the position so that we can actually pay out at the end of all this. So obviously, when you trade, you're not likely trading against somebody like yourself. It's very rare that all the customer flow nets out. A lot of it does. A lot of the flow that you see is also market maker versus market maker. But what's critical to understand is that there's a net imbalance in the end, right? If one of you on the feed, let's say Andy L probably is like an option buyer. He's going to buy calls, and then maybe 141 shaker sells them, but not perfect size, right? Andy's big account, he's going to trade 500, and then he's going to get filled on the other side by 100 lot. 400 outstanding have to be sold by me as a market maker. When we make this trade, we're going to hedge it throughout its life cycle. Now, critical here, there's only a 400 lot imbalance because there's an offset there, where most likely the 100 lot who sold part of Andy's order is a customer as well. They're not going to be dynamically hedging this. It's just in their IB account or their Robinhood account, whatever it might be, and all of a sudden that disappears from influence. It's something that has happened. Now, what we care about is what about this position gives us some predictive insight into the next flow, right? Because as a market maker, we don't get any kind of free pass. I know a lot of people think that we don't get a free pass to just settle all your trades out of the money or simultaneously, you know, in some kind of quantum realm, screw over all the premium holders. It doesn't work that way. We manage this, and we have to interact with the real market. And so when we do that, that means buying and selling the underlying. You'll notice on my feed, I almost never talk about anything but SPX. I don't like to offer my opinion on something I'm not an expert in. I traded SPX my entire life as a market maker, adult life. That's all we care about. In the SPX right now, the hedging is done in the ES future. It's the most liquid proxy. Of course, you can use SPY, but there is no SPX option. The way we do this is with the ES mini. So the important part to understand is, how do you take the subset of the option position that's held by guys like me at my old firm and firms like it, and from that, get something that tells you when and where this community has to buy and sell futures, right? That's all it is. If you're looking at volume profile or TA, what you're doing is making an inference based on the past, based on priors, and there might be value there. I'm not saying there's not. What's different about option hedging flows is that it's prescriptive. So this is a model that's just fundamentally part of the business of market making. If we don't do it, the P&L variance is terrible, and we don't put up the numbers we need to on the business side to continue in that way. If we don't hedge the position, all we're actually doing is taking the opposite of all the customer flow, which is not necessarily a position that we want to have. It's going to be hedged. Now, at the end of this, then, there's an impact. Some people are right to criticize the idea of trading like a market maker because you can't scale like we can, right? If I'm a market maker, I'm looking at things like maybe a fractional mispricing and skew between a couple of tenors. We're going to be able to take a position there at size and hopefully harvest a little bit of that edge in terms of the normalization of the curve. You don't need to worry about that stuff. That's not going to be where your money's found. In my experience, from switching to the retail side and looking at this with the experience that I had, the value is tremendous, but equally important is understanding how to apply a trading framework to it. So to get from A to Z, you need to first know what's the position, and then how does the hedging work, right? How does the hedging work is important. There's gamma, charm, vanna, and a whole bunch of other complicated Greeks you probably don't need to care about. Those three will get you most of the way there. And then on top of that, what I'll talk about a little bit today, but we cover a lot, we speak about every day in the VS Pro morning meetings, actually, for each day forward, is the morning position. The 0-day position coming up. There's a reason that's critically important, and I'll share that in the charm section that we talk about in a few moments, but that's critical. So I would say 4 pieces: gamma, charm, vanna is maybe a little bit advanced, but there's some really good edge there if you know how to use it, and then positions, which I think kind of bring things together in a very robust way. And then I'll share a couple of trade ideas at the end of this to show you how to gear your mind correctly to apply the right framework. Matt, welcome. Matt just joined us, I think, on the call. There we go.
Hello.
So Matt worked at a much bigger institution than I did, UBS. I think the nexus of ICT's conspiracy, where they controlled the market via this insane secret algorithm, Matt was literally at that bank. So you want to share any insight there?
No,
that's not really how it works, honestly.
There's no big conspiracy where we controlled the market.
No, that stuff didn't happen?
No.
Okay, that's a shame. But big positions you guys manage, obviously.
Yes. We manage very large positions.
Yeah. So as you get into this too, there's some nuance, of course. There are different entities that manage big positions, like what Matt's talking about. They might have a different style, whereas there are guys that only trade things that expire today, won't even price link tomorrow. They're going to have their own style too. That's very much about business process optimization and minimizing the amount of times they have to engage with the market. All these things. In the middle was a firm like mine, where we have a vol model that we believe has edge and value. We manage positions we're willing to carry for a long time, and we also have to engage in the high frequency domain. So there's this continuum, right? And so what I want to drill there is that you don't need to know how every single firm precisely hedges. Where we are in our space, there's interesting things to kind of think about, the different subsets and where there might be some little edge. But for you guys, just know that there's a generalized model here that is valid. You don't need to know, for example, if Jane Street hedges it or doesn't hedge it one way, and Belvedere hedges it another way, CDC. That's not going to be where you should get caught up. For one, we don't have precision. We don't need granular precision. We need to have a correct position and good Greek estimations for the entire complex as a whole. When you zoom out, it's incredible how powerful it is. So I'll show you guys in a minute. Matt, do you want to explain maybe just quickly what makes the positioning data that we have a little bit more robust than what's common?
Oh, sure. So
without giving it exactly away, obviously.
Okay. Well, okay. So a lot of people will just do naive things, just look at open interest and assume that dealers are always getting sold calls and getting lifted out of puts and try and calculate some gamma assumptions based on that. We get the data right from the source, right from the SIBO, and that's really the key. And then not only do we get it from there, but we have our own model. We don't rely on anyone else's Greeks. We have our own model to build out our own Greeks. So you're really getting, I think, the big edge is that we ingest the data from the source, we build it out properly with our own Greeks, and then we get it interpreted by guys that actually, are in the market. I think that's a big edge for us. Like some of our competitors, they might do an okay job of the data, but they can't interpret it the same way we are. We can, because they were never actually in these seats. I sat at a bank I sat at the bank and also worked. We worked together at a market maker, so I've been on both sides of the business and for about almost 30 years. And Volz has about 15 years at the market maker, so we just have a ton of experience. So it's really the quality of the data, the way that we built it out, and the way we built it out was with actual software engineers that worked at market makers. So it's just a very robust data set and interpretation of the data.
Yeah, and critically too, there's no inference. You can see if my screen share is still up. No inference, exactly. So you can see there's nothing is IV inferred. There are some, the old way used to be like just take naive metrics. So spot gamma, for example, started out by just subtracting puts from calls. After squeeze metrics kind of led the way there with this naive Gex model. Now, no insult to Squeeze, obviously. He was very responsible in how he framed this and has done a lot of great work since. Spot gamma ran away and productized that for a while, and people really bought into this idea that naive Gex was a thing. Probably got enough traction where it supported itself, right? Where realistically, you can't dismiss the idea that if enough people use a thing, could be anything, could be moon cycles, it will have value once it's actually applied to the markets via supply and demand, right? If everyone's buying at a level, it doesn't matter if that level is completely ridiculous and based on nonsense. If it's happening, all you need to know is where the demand is. So that held muster for a while as like the way to interpret dealer gamma. There's a lot of written stuff actually in the public realm that kind of has seeded this strange incorrectness in a lot of the AI models too. Again, that premise is invalid. This idea that we can only own calls and be short puts is one of the most, we don't even need to explain why that's not valid. If you've ever yourself bought a call, you've invalidated the entire premise. Now, the next level, right, is inference. There's two ways to do inference, and I won't talk too much about this. We can get to the rest of the stuff. But the first way is just assume that we need to make money off you, which means that we're going to charge you a haircut on the bid ask. I'm going to make my market $1 at $2. And if you're going to offer me 160, I'm going to hang up the phone. You sell it to me at 110, I'll buy it. You pay 190, I'll sell it. From there, if you think that that's the way the business model works, you look at all of the time and sales, right? So instead of just open interest, now you're looking at time and sales data every day, and you're filtering every single trade and saying, oh, that's a buy, that's a sell, that's a sell, that's a buy, that's maybe ambiguous, ignore it, etc. And you do this over the life of every single contract, and eventually all the bucketing creates a position. There's problems with that. If you guys are creative, you can probably imagine some of them. If you read through my tweets, you know what the problems are already. But let's even just ignore all those. I will tell you right away that it's not accurate. Markets have to be very, very tight. That means that the market, the fair market, is actually variable according to depth and quantity representable. So we might make a market $1.10 at $1.30, but the real size might be dollar bid, and the real size on the offer might be 170 offer. And then there's variability all the way in between. But that displayed market necessarily omits all the information about where we really hold value. So you don't get good information. But even more importantly, if I accepted, the Wizards' claims, for example, that all of this can be done with perfect inference, and you're going to have a 99.99% hit rate. At the end of the day, you're missing something critical here, which is who holds which positions. Because again, if Andy trades with Shaker and they cross on all those positions or those trades, there is no hedgeable position. So neither of them are doing anything dynamically. But you have a big trade that just showed up in time and sales that you're going to assume was bought by a customer, Andy, even though a customer also sold it to him, and it's a wash. So you've now inserted something into your model, which you're going to have there for a long time, which is invalid. It'll create noise and distortion around the real signal, which you may be lucky enough to cross over sometimes meaningfully. So critically, again, unless you know which portion of the open interest is held by people that are hedging it, you don't have anything that represents a dealer hedging model. You have a toy, okay? So next thing we'll talk about is we get this just from the exchanges. We have to pay the man a pound of flesh. It's expensive to get the right data. It's expensive to build a model to ingest all this data, normalize it, clean it, and backfill it. It's expensive to distribute it. There's a reason everybody uses open interest, because it's free for the most part. So this is a more expensive way, but it's something that we can stamp our name on, our seal of approval, and say, this is correct. By every standard we have available, there's nothing more correct than this. If anybody claims to have a more correct thing than what the exchange and the clearing firm tells them is the correct answer, they're deceiving themselves or you, and I would probably not subscribe to that, right? So what we have here, I'm going to log into the platform in just a moment. But again, the point is these are real positions. And first thing you're going to notice when we log in is the positions are not huge. They're kind of small. So whenever you see giant positions, especially that round numbers, just remember there's a lot of reasons to have options in the open interest that do not actually influence the market at all. They will look like they do. You'll see a lot of tweets from experts that say they do. They don't. You guys can see the screen still, right? Yes. Okay. So here is the 0-day dashboard. You'll notice there are three things fundamentally on my screen. You have a bunch of bars on this side, positions by strike. You have gradient chart that represents gamma, and then one that represents charm. First, we'll just cover gamma briefly. The concept of gamma, most importantly, what I want to get at here is there is a regime gamma behind us. As people sell options or buy options in varying quantity and cadence, the extent to which market makers own options generally will mean that the market in general, again, has a positive gamma to it. What does positive gamma mean? Gamma literally is D delta D spot. And delta, of course, is how does the option price change when the underlying changes. An option that moves higher by 50 cents when the stock moves higher by $1 is a 50 delta option. Okay, so how much that then varies is gamma. The reason you care about gamma more than delta is because you assume that delta is hedged. It is. By the time you see a trade in the profile, it's hedged. It's absorbed into a book that is delta neutral for the most part. What we care about is not what has happened, it's what will happen next, right? And gamma telling us how does the delta change tells us literally how will market makers have to hedge, remember, have to buy or sell futures, which we care about for impact, in order to keep their delta neutral as the underlying moves. So gamma is about underlying movement, and it's conditional. It requires movement to make the delta of the position different. And then the market maker can stand in and provide liquidity if they're in a positive gamma position, or in circumstances like you kind of see here, this is not a very healthy profile in all honesty. This is a negative gamma market right now, where this is kind of rare. Like Matt, what would you say is a typical exposure to see?
Exposure is usually we see at least 5 to 10 billion positive in the dollar per percent number, which is the number that, like, if you've seen bank reports that everyone uses. So yeah, normally it's and now where are we now? We're like it's
negative or zero most of the way.
Yeah, we've been very negative, and you can tell I mean, and that's what's so powerful is that you can tell because the market's been trading. Oh yeah, look at that. We're really the market's been very, very choppy.
Yeah, so the maximum amount of gamma in this range this morning on the profile is about 1/15 of a normal, healthy, positive gamma market. That's really good clickbait. I should probably tweet that. But it's just tiny. So this is a market that can move a lot. And you see it already in the overnight session. Gamma, again, is not directional, right? There are a couple of things I need you to understand here, too, to make sure you get the right information out of this. Gamma is not directional. Gamma tells you something about market behavior. Market behavior meaning volatile or placid, not volatile. When gamma is positive and large, it literally means that market makers can provide a lot of liquidity to the book. And so if you think about a book ladder, right, like Squeeze Metrics had a really good paper on this at one point. It's called the Implied Order Book. I highly recommend reading it. If it's a like a market depth issue. Imagine a futures ladder, for example, with these ghost orders stacked up in varying quantities. In a high gamma market, you have hundreds of futures stacked up on both the offer and the bid, depending on, of course, on the magnitude of gamma there, which kind of just tells you that a big order right now will be absorbed. And as you trade and multiple big orders are thrown into the market does not move as much because of that, right? There's a lot of absorption going on. If you think about it very basically, well, I guess it tells us right in the platform, hedge product to trade right there cuts from the beginning to the end to give us the answer of like, what happens if the market goes up $1? Literally, the hedge product to trade tells us the answer to the question. If the market rallies $1 right now at this spot time reference, what do market makers as a whole have to do per the model? So this tells us that we're in positive gamma technically. I know it doesn't look like it because I keep my settings to reflect neutral gamma when it's like this. But right now, the positive exposure tells us that if we move up $1, market makers have to sell 40 minis. That is very little bit compared to normal. Usually it might be 400. Yeah, exactly. That doesn't mean, again, it's precise and you have to know exactly. No, this is about scaling your expectations according to the general magnitude and direction. This is a market that can move a lot. Okay. So here on the profile, just very quickly, and again, this is like this is a very quick crash course or slice of like our onboarding sessions that we do every week. So this obviously VS3D, our platform, in order to get you guys adapted to it during your free trial from Monday through Friday, Matt and I hop on a call from 1 o'clock to 1:30 Eastern, and then have a Q&A afterwards to talk about every single one of these concepts that we're going to talk about today, obviously in brief today. But so just know that if you have questions, that's where you get them answered in depth too. But just very briefly, these dotted lines are your flips. They're going to happen multiple times throughout the day because we have 0-day options. In the past, you had one flip. If you go back to reporting, for example, and search through archives on Zero Hedge or spot gamma notes from, prior to 2023 and 2024, you'll see all the time this idea that there's a gamma flip. There's a gamma flip. It's coming. This is just where that big sweeping open interest distribution crossed the axis, where like puts and calls were kind of balanced. It didn't really tell you a whole lot. We have gamma flips all over the place for two reasons. One, we actually have a real option position where even 10 years ago, before 0-day options were prevalent, we knew in our position that there were ranges. They were wider at the time without 0-day options, where gamma was positive, then it was negative again, then positive, then really negative for a problem, and then really positive. That was typical. It was not just one flip. Today, it's more obvious, and there's multiple flips throughout a day's range sometimes, especially on positions like this. The zero bound doesn't necessarily mean anything specific. It may have certain properties, but none of which I would encourage you guys to look for as super meaningful to trade. There's a lot of dishonest marketing in this venue where people love to put like an image of price bouncing off a line or a dotted line as if like that's the be all end all of their platform. And they'll of course ignore all the times where it goes around it, through it, away from it, doesn't matter. It's just a zero line. Negative gamma is riskier than positive gamma, of course. The real value in this, let's see if I scroll up here. You're going to probably start to see a call wall emerge, if you know that term. There we go.
Yeah,
if you're long today, here's how to know how to use gamma, right? If you're long today and we start to get a real move, right? If there's a vol crush that sends us higher, I'm not going to talk a lot about Vanna, but just keep that in mind. If a vol crush starts to send us higher and you're long today, well, there's nothing stopping the buying from impacting the market in this range. 1,000 minis might move us $7 to $10. Who knows? By the time you get here, it's a very different market. This is literally saying right here at the maximum locally right now, market makers have 43 minis to sell on a $1 uptick. By the time you get into 69 quarter-ish, 69.30, that is fivefold. Now it's a 200 lot. By the time you get to 69.60, it's tenfold. It's a 400 lot. And this is why you see price action that starts to just go concave. A really sharp rally. We've had a lot of these in the last 2 weeks where we have really erratic price action. All of a sudden the market finds its footing directionally, goes straight up, and then it just hits a wall. And it seems to it's like it's trying to push through, but it really can't. The reason it can't is because it literally went from an area where there was no provision of liquidity in the offer. There was no selling. There was no available quantity for for sale. And then here, there's 10 times that. It's just a massively different market. And it's not about active selling or market makers trying to push the market down. And it literally doesn't happen unless you go up. I want to keep that clear too, because there was a question on my Twitter that kind of alluded to that. It's not active. It's just a difference in character. So the gamma isn't directional. The direction was established already. But in this range, the direction is much more potent. It's more powerful. You can just go. And all of a sudden here, it kind of stops. And so there's two things to think about here. If you're directional and you have a trade on whether futures or options, you can orient towards where's my exit, right? Where do I stop on this trade? Where's a healthy time to just say, take profit and go? Because now all of a sudden my expectation should be for a lot more risk, right? In this range specifically. Like if you're going long down here and whatever triggered your long, whatever, you have a much greater expectation of distance. You can make a lot more points on that spread. Whereas up here, you should expect much more risk here, because if you go back and reverse, you're going to lose a lot quickly. But here, it's just going to chew through gamma, and it's going to be very flat price action. Not healthy for a, you don't want asymmetry that way. Makes sense. So that's obviously one angle. The other angle with gamma is realized vol. The market will always subside, all things equal, where the market will always subside into less realized vol locally around areas that are high gamma areas. That should be true as a rule. It doesn't mean that we know the answer all the time, because of course we don't know what the market would have been like if it was a negative gamma. I know it's an untestable hypothesis, but generally the data supports this too. And you see it over time. And if you've been watching this stuff day by day, you see the difference in character when the market hits a positive gamma range. You guys can also play around with this in your trial or as a member and switch and toggle to historical and go back and look at prior days to see exactly what we're talking about. So much of the time, price respects this rule where as soon as you hit that really strong gamma range, movement's done. Matt, you want to explain charm really quick?
Oh, yeah. Charm. So, whereas he was just describing gamma and it really affects like the speed of the market, charm affects more the direction of the market. So charm is basically how your delta changes over time. And what we do in VS3D is we break it down into 5 minute increments. So we look at all the positions and we say, over the next 5 minutes, all else being equal, how many minis do market makers need to buy or sell? If you put your tooltip anywhere on there, let's get mine.
I'm sorry.
That's all right.
Do some hedging trades. PPI came out, so we had a sharp move down.
Ah, that's what did it, right?
Yeah.
Oh, yeah, PPI. Oh, yeah.
But perfect that you're talking about calls around these data points, because charm tells you a lot about what to expect when these events come out. So if you're looking at how to use the data, if you understand, and this is what we go over in mentorship, like how to really drill down in things like these events and the events coming out, there's a prescription that is much better than a coin flip for which direction the market should go as a first reflex. Yes. And today we'll talk a little bit in the position. Matt's going to talk about the thing right now, charm, which is kind of a tell. But
here we go. So charm right here. We don't have a ton of charm right here actually, but it basically tells you, what market makers need to do every 5 minutes, all else being equal. So in this case, market makers need to sell 23 minis. About 23. Let's make it. Yeah, I have 23 on mine. 23 minis every 5 minutes. So over the day, like the beginning of the day, the charm isn't as powerful, but it's really in the second half of the day that I shouldn't say that. It can be when you have an event like this and like a data point, and then vol comes out after the data point. But we're not going to focus on that so much right now. We're going to focus just more on the traditional charm.
Yeah, most days it's more valid later.
Yeah, the last half of the day. So it can be very, very powerful. And it's just like over time, how many minis do the market makers need to buy or sell? And so it really can be very instructive on the direction of the market. There's some days, today it doesn't, in this range, it's not too big. We stay around here. By the end of the day, actually, we'll start to charm up. But for the first half of the day, it's not huge. Yeah. So that's charm.
Yeah, it's an interesting one today too, because
oh yeah, PPI was high. Oh, look at that.
Yeah, so the way I think about this, by the way, so everybody always asks about data points, right? The way you should understand data points, people used to think about these as headline algos. There may be some of that. I've known someone who made really good money off that, but many years ago. What I think is more likely today, which you should orient towards, is there a reflex in the position that's causal? And why and how do I find it? The reason it's so powerful and why you see these really sharp moves that sometimes don't even align with what the market eventually thinks about the data is that, again, you have two perfect things going on at a data point. The liquidity disappears. So whatever hedging has to happen happens into a void. And so you have more impact, right? So step one, you're going to get more distance on your trade. Next thing that happens is there's an instantaneous change in the delta. That's kind of like a Vanna influence, kind of like a charm influence. It takes a little bit of drill down and working with to understand exactly where it comes from and how much of it to expect. But there's correlation with the 0-day position and the background overall charm profile when these numbers happen, and Vanna as well. And it'll tell you literally if you should expect the market to knee jerk and reflex down or up, which of course is super important, especially when the market does a wrong thing first. You get maybe good reversal trades, but really when you're thinking about these things, if you can get better than a coin flip, you can get 65% accuracy on direction when you're getting moves that are this big in a very short time frame. You can probably figure out a way to make money there if you've ever traded. So I would say this is very powerful. Charm, if you didn't even cover it in the beginning, again, is delta change due to time passing. The reason it's like Vanna, and we won't talk about Vanna specifically, is Vanna is like bidirectional charm. Charm is like one half of Vanna. Meaning, in terms of option pricing, time is volatility. You can raise an option's price by raising its implied vol or raising its time to maturity. And conversely, you can drop the price too by doing the same thing. And so they behave very similarly. There's only a minor, for practical purposes, understand them as identical. Time just goes in one direction. But if you want to think about what an influence would be if we had a really sharp vol spike, for example, it's the opposite of the charm profile. It's obviously important to understand it is the thing that gives you a directional bias. People ask me like, oh, won't this just be arbed away? Won't market makers try to exploit the fact that people know this? No, maybe it will, maybe it won't. It's not that easy. For one, market makers have a different problem to solve and they're making billions of dollars. They don't care if you're making hundreds of dollars or thousands of dollars. They're doing just fine as long as we're trading. The other thing that's important is, and this, I can't stress this enough, the thing that would make this edge go away is continuous settlement, like the elimination of an option concept. The fact that there's a shot clock on every option means that at the end of the day, it has to be 0 delta or 100 delta, or positive or negative, and there's nothing in between. And so because we're hedged dynamically, continuously, whatever, delta neutral, it's the process of moving from 0 to either 100 or negative 100 on that option that gives you a tradable directional bias, which is really powerful. Again, if you look back prior to 0-day, nobody talked about charm really, for good reason. Because if I showed you the charm profile without 0-day options in it, the exposure would be 1/10 the size, maybe 1/5 the size. At most. And you wouldn't have a lot of information there. And I was talking with a mentorship guy yesterday, actually. The farther out in time you go, the more variability you have in vol. So if charm is like a certainty, time passes, its effect is strongest when it has 1 date expiration. If you go out in time, time is still passing, but it's very minimal impact on the option itself. And then you have volatility that can move around in either direction and really generate a stronger delta change than time ever will for those options. So 0-day options and the fact that there's a settlement every single day, most powerful driver of directional bias in the market, I think. Doesn't mean we'll have to go there, but it's kind of like you get, 60, 70% chance of a certain directional influence. And then conversely, oftentimes it's juxtaposed against gamma. And so it gives you an idea of where price might land. And also, if we had a converse move or an adverse move, it's usually going to be bigger for the same reason. Someone asked a question that depends if the options book market maker is holding in the money or out of the money. Perfect segue to positions. So on the left side, you have positions by strike. It says right here, 0 day. Matt, can you describe what each bar actually means?
Yeah, that is the amount of options that are held by market makers at each strike. Very
And you said
powerful.
options.
What?
Options, not, and keyword, you said options.
Options, yes.
Not calls, not puts. People often
Options.
mistake this side for puts, this side for calls, but it's actually negative quantity here, positive quantity here.
Yeah.
And why do options matter more than what type of option?
Because we assume that all options are hedged. What's the correct?
Yep.
The market makers hedge. So once an option, if a market maker buys a call, they're selling delta. If they buy a put, they're buying delta, and vice versa. So it doesn't matter at the end of the day whether it's a call or a put. We just assume that the market makers are hedging them all delta neutral, which is the correct assumption.
Put call parity holds pretty strict in index. What that means is literally from the moment the trade is hedged, whether it's a put or a call, you can walk through this simulation yourself. I've done it before with clients or people in the Discord. If you walk through the simulation of what the hedging means for the same strike option and the same maturity, step by step, for time passing, for vol changing, for spot changing, it's identical. You have an option that's a put or a call, same strike, same maturity. If the market goes up, the gamma influence is identical. Market goes down, identical. Time passing, identical. So they're the same. No netting. This is not call minus put nonsense. This is literally the option position at the strike and the net held by market makers. Follow? And so to this question here on the YouTube stream, I believe, but that depends if the options book market makers holding an option that's in the money or out of the money. Yes and no. So you can skip a step here mentally and make it more intuitive for yourself. We don't have the live price updating here yet. Pre-market, this will be adapted soon. You can see the straddle price is updating, actually.
Yeah.
I think within a short time frame, we're going to have much more active around the clock global trading hours. What's this called? Spot reference as well. But so imagine for a moment that spot is still at 69.08. For reference, it's actually 68.44. So if your inputs this morning, congratulations. Hopefully it holds for you. But here, the spot price of 69.08, these options up here, think of them as calls. Doesn't matter if they're in the money or out of the money. Think of them as calls when you look at the profile, right? Dealers are short upside calls here. And conversely here, anything below the at the money reference, they're puts. It's very intuitive. It should be intuitive and easy to understand that way. You can skip whether it's in the money or out of the money. A downside strike is a put option. An upside strike is a call option. The reason is, again, to simplify how you understand charm and Vanna for this purpose. Of course, as a market maker, you need to know if it's a call or a put when you hedge it. But for charm and Vanna, for that dynamic influence, because of put call parity, the most important thing to understand is proximity, or I should say rather relative position to spot. Again, because if you think about this, let's say I bought a call option. It's above the money. If it's a 20 delta call, that same strike would be an 80 delta put. If it's a call option, I buy the call, and for 100 lot of SPX, I have to sell 40 futures. If we rally and that becomes a 30 delta call, I have to sell an additional 20 futures. So I go from short 40 to short 60. That's gamma. Now, if time just passes where we're at that level, it's a 30 delta call, and it decays back to a 20 delta call. This is charm. I have to buy back 10 delta or 20 futures to get my delta to reflect what it is now, mark to market. So I buy back 20, taking me from short 60 to short 40 again. Let's just keep fast forwarding time. And all of a sudden, that call is going to be worth nothing. It's out of the money. I have to buy back the entire 40 futures left, right, to take the delta back to zero. Now the call expires, worthless, gone, we're done. That was the upside 20 delta call. Now let's imagine if it were a put. The same exact strike would be an 80 delta put. At the time of trade, instead of selling futures, I have to buy them. For an 80 delta put, 100 lot, I have to buy 160 futures, right? Buy 160 futures. That impact is behind us. Maybe it moved the market when it happened, but it's gone. We don't care about that because we can't do anything with the past. Now, what happens if we move up? Remember the last example on the call. If it's true that they're the same, they should be the same as we do this exercise, right? The last example on the call, we moved up and the call went from 20 to 30 delta, which means the put should go from 80 to 70 delta, which means that we actually are now overhedged. Remember, we bought 160, But now the hedge ratio should make us have to own 140. We have to sell 20 futures on this move against the put to make us no longer overhedged. Same exact thing we did with the call, right? Now let's just advance the clock. We advance the clock the same way we did with the call. It's now a 20 delta again. So I have to buy those back again. Now we're just going to fast forward again to the expiration. At the expiration time, right into it, the put will have 100 delta, not 0, right? So whereas the call had 0, the put is going to actually continue its hedge until it's 100 delta, fully in the money, which means I have to keep buying futures. So the call, I had to buy futures to unwind a hedge against the out of the money option. The put, I have to buy futures to continue to complete the hedge against the in the money option. But in every circumstance, every single step, exact same quantity. So it doesn't matter. Hope that makes sense. To option Z's question, we probably won't even notice since ES trades in such high volume. No, exactly incorrect. Just like when you look at the SPX zero-day volume, and I've confirmed this with market makers that are active and dominant in zero-day right now, the zero-day volumes that you actually see, I think the CBOE reports this data themselves. The majority of it, literal majority of it, is market maker versus market maker. So that's noise, right? That's just noise. That's literally not the fact that market makers want to trade. It's just small bid asks and different models and fast markets. And so those bid asks are constantly crossing and changing. And then each market maker might have some optimization in their model to try to close positions. They're shuffling back and forth all the time. Mm-hmm. That produces a ton of volume. So you're going to look at the volume numbers and say, how do these numbers matter? Because I saw yesterday that on this strike, 7 trillion options traded, and that must be important. How can you say that 3,000 makes a difference? Well, because of those 7 trillion options, 6.999 trillion were just noise. Great for the exchange, great for marketing numbers, but the market's not that deep. If you really thought the market was as deep as that just implied, you would not see any of the moves that we just saw 5 minutes ago, right? Matt can attest to this. He was in the banking side for a long time. He would have to go trade 10,000 lots of really important spreads. You could not get the same volume done in 2024, for example, that you could 7 years prior. I don't think the market's as deep as you guys think.
Yeah, I agree with that.
Strikes tend to be magnets, perhaps, yeah. There's also just a function too where volume is where spot is, right? So that's also going to be true. You're going to find strikes with a lot of volume have proximity to at the money. There are also just round number strikes. Human beings are prone to just simple things. We're going to be round number biased. And you're going to see a lot of volume all the time on strikes like 7,000, especially in quarterly months. But it's just boxes and rolls, things that don't matter. This subset of positioning we give you is the one that matters. Mm-hmm. Let's see. Is the charm color opposite still? The charm color is just whatever you set it to be. So the charm color here is reflecting exposure. So exposure in this profile, we have 2 options. There's a general option for green, red, and then blue, yellow. Blue, yellow is actually just a protanopia color type. As a market maker, I'm colorblind. So when green gets really deep for me, it looks red or brown. And when red gets really deep for me, it looks brown and it looks the same. They thought I was mentally handicapped when I was a kid because I drew trees inverted, like really bad standards then. But now, but more importantly, I guess than that, when I was a market maker, I tended to be pretty aggressive. And oftentimes when something was really, really well under offer, I'd want to just turn on my risk settings and buy as many as I could because I would just try to be aggressive on the other side of it. Problem was it would look really, really bid to me. So I would sell things really, really aggressively, really, really below market sometimes. And that earned me the position of head of UX design, so I could be responsible for color blindness. This is a colorblind profile. It just solves for that. It's not about any kind of convention or like perfection or whatever. You guys can change these settings to whatever you want. I think my kids love this actually because it's just updates as you go. But I like this. Whenever you want to check, just look at exposure because exposure tells you what is happening in the delta. Hedge product to trade tells you here what's happening in 5 minutes time. And so blue in this case is bearish because a position that's getting longer delta has to be hedged. We care about the hedge. So it's a selling that's bearish, right? Quick trading takeaways. So I kind of alluded to some of them before, right? We have the obvious one right here on the top. Where gamma is super positive, it's going to create stopping power no matter which direction we're going. Oftentimes we get V bottoms because there's just more natural buyers and sellers, of course. So market's going to turn around sometimes when it finds some support. It kind of gives time for the next bid to show up. And then if you're bidding through a range that was very light gamma, like you can imagine, sometimes we get these sells through these areas where there's no liquidity. And then we find gamma on the bottom somewhere, oftentimes like this, where we find a little bit of flattening in the price, just like we would on a rally. But then it's that support that signals to everybody on, every other desk in the world, just buy. And we reverse right through it sometimes. So look for changes in the market's character as signaling potential support or resistance. That's just generally the case. In this area, it doesn't mean we have to go the entire distance. We almost never do that. It's rare. More likely, we just kind of go like this sometimes and eventually find a stop at one end or the other. It's technically pretty rare to pin these areas here. What can you do with this besides directional trades? You'd want to sell options up here and not sell them here. I'll be very frank. You have to get really well compensated here to sell options. You can buy options in this range and sell options here with call spreads, with flies, right? The idea being that whenever you're structuring a trade, you want to buy the options you think you're going to go through and sell those that you're going to go to, but not through. That does two things for you. The fancy wonky thing to say is that you're exploiting localized realized volatility, being correlative with gamma, right? So we think that this information here gives us edge in knowing that this range will have higher localized realized volatility than the options signal. And we think conversely that in this range, the options will under realize. They're priced too expensive actually, and market makers can't easily correct for this. Not as granular as you'd find you can exploit with your own trades. The fancy or the non-fancy way of saying it is like, we're going to move more here, so your options will pay more. You want convexity. We're going to move less here, so you're going to sell convexity to someone else who's going to overpay for it. So you buy a call spread, for example. This cheapens your exposure. Instead of just paying the premium for the one strike, you cheapen it, and you'll actually get outperformance a lot on the one you bought and underperformance on the one you sold. Really good basic pairing. I like flies to go one step farther even and target where I think we're going to land.
Yes.
Yep.
Harder today. We should probably wrap up, and we got to get to the morning meeting at 10 minutes.
Please. Thank you, Daniel. I appreciate the comments on the YouTube too. Great name, by the way. But I also know you were a market maker before. Who is a typical market maker today, and how do they tend to be dynamically hedged? Yeah, that's great. I think that's a great question. There's a subset of market makers that are definitely very tightly hedged, very tightly wound. There's a subset that, like have street names or something that are probably more loose, sometimes very creative with how they pair things in order to carry more risk because they're going to have more edge there. It's not without risk to capture that edge, and there's gray area all the time. Not to overcomplicate it, but there are a few firms that have loose boundaries. I would say by and large in the SPX, the majority of the firms that kind of drive order flow are much more rigid, right? With zero-day options, you have to be pretty rigid. You're not going to let your delta run for a long time because then you kind of, you're just trying to protect the edge you get from trading back and forth. We were kind of in the middle where we would have a combination of interval-based hedging that was informed by the position, and then a frequency-based hedging as well. And so it was basic and not super complicated. You can go one step farther, for example, and try to identify regime, where maybe you're going to actually use one or the other. You'll see over time when you use this information, I think you can actually get a lot of regime identification information out of the net position. And so if market makers are going to use this in one way, I think probably it would be informing their individual hedging processes, not trying to like structure option positions. That'd be better. Cool. Discord link. Yeah, that's a good idea.
I posted it in the YouTube chat, but I don't see it now.
Awesome.
So it may have gone away, but the Discord link is there again. Let's see if it stays up or not. Yeah.
I'll post it in both anyways. I think this goes to YouTube, I hope. I know it doesn't go to X.
Yeah, it doesn't go to X.
Yep. Yeah, cool. So we're going to run our morning meeting as normal. So the morning meeting is part of VS Pro. So if this is interesting to you guys, obviously I think it helps a lot to go through it every day. We used to do this as market makers where we had morning, pre-market calls every day to kind of drill what our expectations were, what we need to do our position. Obviously, you guys have your own positions and trades, but what we do is we get together every day at 9 o'clock. I talk about the 0-day profile. Matt talks about the vol surface. Nick talks about some really great single name setups, and then we just go trade. So we'll share our ideas, our read, our interpretation, whatever else looks interesting. Like skew's been a hot topic lately, so I talk about that a lot. Some days are just boring, and then they are what they are, but it's always just our view, exactly what we're seeing, and an opportunity to kind of question us or get feedback on whether you need some help with the Greeks, etc. We're going to do that. We do it at 9 o'clock. I invite you guys to come today. Today, we have to do it in the Discord. The reason is we do it on Zoom, not the live stream stuff. I've tried to do it in the past to do both. Sorry. Every time you've seen things go like crazy off the walls, like ridiculously bad tech, it's because I'm trying to jam things together at the last second. Not going to do that. Just come to the Discord. The link is in the chat. And then there you have, we'll post a link there also to direct you to the event stage, where we've made the morning meeting free today. So we'll stream the Zoom call to the Discord stage. You can see and follow along, and of course, ask questions. Cool.
Perfect.
And then if you want to subscribe to the main Discord as well, I should put that here because it's not obvious. We're much better at all the trading part than the marketing part. I get asked all the time, like, how do I sign up for your service? I'm like, I actually don't know.
Yeah.
That's not good.
No, good. We need help.
It's more authentic.
Yeah. So any real ace marketers or ace business guys out there, feel free to connect with us because we can trade services. But otherwise, see you in the Discord.
All right, we'll see you guys soon.
All right, guys, see you there.